Stock market for beginners. A comprehensive guide. Introduction to the stock market. The stock market is a complex and dynamic system where individuals and institutions buy and sell shares of publicly traded companies. It serves as a platform for investors to participate in the ownership of businesses and to potentially earn profits through the appreciation of stock prices and dividends. While the stock market may seem intimidating to beginners, understanding its fundamentals is crucial for anyone looking to embark on their investment journey. What's a stock? A stock represents ownership in a company. When you buy a stock, you become a shareholder, which means you own a portion of that company. Companies issue stocks as a way to raise capital for various purposes, such as expanding operations, investing in research and development, or paying off debts. Types of stocks. Common stocks. Common stocks represent the majority of shares traded on the stock market. Shareholders of common stock have voting rights in the company's decisions and may receive dividends if the company distributes profits. Preferred stocks. Preferred stocks also represent ownership in a company but usually do not come with voting rights. However, preferred shareholders have a higher claim on the company's assets and receive dividends before common shareholders. Understanding stock exchanges. Stocks are bought and sold on stock exchanges, which are platforms where buyers and sellers come together to trade securities. Some of the most well-known stock exchanges include the New York Stock Exchange, NYSE, the Nasdaq Stock Market, and the London Stock Exchange. Each exchange has its own listing requirements and trading rules. How the stock market works. Supply and demand. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price will go up, and vice versa. Market participants. The stock market consists of various participants, including individual investors, institutional investors, such as mutual funds and pension funds, traders, and market makers. Market orders versus limit orders. When placing a trade, investors can choose between market orders, which execute at the current market price, and limit orders, which specify a price at which they are willing to buy or sell. Risks and rewards of investing in stocks. Potential rewards. Investing in stocks offers the potential for significant long-term returns, especially compared to other asset classes like bonds or savings accounts. Historically, the stock market has provided an average annual return of around 7 to 10%. Risks. However, investing in stocks also comes with risks, including market volatility, company-specific risks, and the risk of losing your entire investment if a company goes bankrupt. How to invest in stocks. Brokerage accounts. To buy and sell stocks, investors need to open a brokerage account with a reputable brokerage firm. Online brokers offer user-friendly platforms that allow investors to research stocks, place trades, and monitor their portfolios. Research and analysis. Before investing in a stock, it's essential to conduct thorough research and analysis. This may include studying the company's financial statements, analyzing industry trends, and evaluating the company's competitive position. Diversification. Diversification is a key strategy for managing risk in a stock portfolio. By investing in a variety of stocks across different industries and sectors, investors can reduce the impact of any single stock's poor performance on their overall portfolio. Long-term versus short-term investing. Long-term investing. Long-term investors buy stocks with the intention of holding them for many years, often decades. They focus on fundamental analysis and are less concerned with short-term price fluctuations. Short-term investing, trading. Short-term traders, on the other hand, buy and sell stocks frequently, often based on technical analysis or short-term market trends. While trading can be profitable, it requires a significant amount of time, effort, and risk management. Monitoring your investments. Once you've invested in stocks, it's crucial to monitor your investments regularly. This involves tracking the performance of your stocks, staying informed about relevant news and events, and periodically reviewing your investment strategy to ensure it aligns with your financial goals. Additional tips for beginners. Start with index funds or ETFs. For beginners, investing in index funds or exchange-traded funds, ETFs, can be a great way to get exposure to the stock market with minimal risk. These funds track the performance of a specific market index, such as the S&P 500, and offer instant diversification across multiple stocks. Practice with virtual trading. Before investing real money in the stock market, consider practicing with virtual trading platforms that simulate real market conditions. This allows you to gain experience and test different investment strategies without risking your capital. Set realistic goals. Define your investment goals and time horizon before investing in stocks. Whether you're saving for retirement, a down payment on a house, or your child's education, having clear goals will help guide your investment decisions and keep you focused during market fluctuations. Stay informed. Stay informed about financial news, market trends, and economic indicators that can impact stock prices. Follow reputable financial news sources, subscribe to investment newsletters, and consider joining online communities or forums where you can discuss investment ideas with like-minded individuals. Avoid emotional investing. One of the biggest mistakes investors make is letting emotions dictate their investment decisions. Fear and greed can lead to impulsive buying or selling, which can result in losses. Stay disciplined and stick to your investment strategy, even during periods of market volatility. Common mistakes to avoid. Timing the market. Trying to time the market by predicting short-term price movements is a risky strategy that often leads to losses. Instead of trying to buy stocks at the lowest possible price or sell them at the highest, focus on the long-term fundamentals of the companies you're investing in. Overlooking fees and expenses. Be mindful of the fees and expenses associated with investing in stocks, such as brokerage commissions, management fees for mutual funds or ETFs, and taxes. These costs can eat into your investment returns over time, so it's essential to choose low-cost investment options whenever possible. Ignoring diversification. Failing to diversify your investment portfolio is a common mistake that can expose you to unnecessary risk. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of any single investment's poor performance on your overall portfolio. Chasing hot stocks. It can be tempting to chase after hot stocks or follow the latest investment fads, but this approach is often speculative and can result in losses. Instead, focus on investing in high-quality companies with strong fundamentals and a proven track record of success. Resources for further learning. Books. There are many excellent books available on investing in stocks for beginners, including classics like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel. Online courses. Numerous online platforms offer courses and tutorials on investing in stocks, often taught by experienced investors and financial professionals. Websites like Coursera, Udemy, and Investopedia offer a wide range of courses catering to beginners and advanced investors alike. Financial advisors. If you're unsure about how to start investing in stocks or need personalized guidance, consider seeking advice from a qualified financial advisor. A professional advisor can help you develop a customized investment plan based on your financial goals, risk tolerance, and time horizon. 14. Tax considerations. Capital gains tax. When you sell a stock for a profit, you'll typically incur capital gains tax on the difference between the purchase price and the sale price. The tax rate depends on how long you held the stock before selling it. Short-term capital gains, held for less than 1 year, are taxed at ordinary income tax rates, while long-term capital gains, held for more than 1 year, are subject to lower tax rates. Dividend tax. If you receive dividends from stocks you own, those dividends are generally taxable as well. Qualified dividends are taxed at the same preferential rates as long-term capital gains, while non-qualified dividends are taxed at ordinary income tax rates. Tax-advantaged accounts. Consider investing in tax-advantaged accounts such as individual retirement accounts, IRAs, or employer-sponsored retirement plans like 400 and Onyx. Contributions to these accounts may be tax-deductible, and investment gains grow tax-deferred or tax-free until withdrawn in retirement. #15. Market psychology and behavioral finance. Market psychology. The stock market is influenced by the collective emotions and behaviors of investors, which can lead to market trends and cycles. Understanding market psychology can help investors navigate periods of market volatility and make rational investment decisions. Behavioral biases. Behavioral finance explores how cognitive biases and emotional factors impact investor behavior and decision-making. Common biases include overconfidence, loss aversion, and herd mentality, which can lead investors to make irrational or suboptimal choices. Risk tolerance. Assess your risk tolerance or your ability and willingness to endure fluctuations in the value of your investments. Your risk tolerance should align with your financial goals, investment time horizon, and comfort level with volatility. #16. Ethical and sustainable investing. Environmental, social, and governance (ESG) criteria. Ethical investors may consider ESG factors when selecting stocks, such as a company's environmental impact, social responsibility, and corporate governance practices. ESG investing aims to generate positive social or environmental outcomes alongside financial returns. Impact investing. Impact investors seek to generate measurable social or environmental impact alongside financial returns. This may involve investing in companies or projects that address specific social or environmental challenges, such as renewable energy, healthcare, or affordable housing. Sustainable investing. Sustainable investing integrates environmental, social, and governance considerations into investment decisions with the goal of promoting long-term sustainable business practices and mitigating risks related to environmental or social issues. 17. International investing. Global diversification. Consider diversifying your investment portfolio internationally to reduce risk and take advantage of growth opportunities in foreign markets. International stocks may offer exposure to different industries, currencies, and economic cycles than domestic stocks. Currency risk. Investing in international stocks exposes you to currency risk. The risk that changes in exchange rates can impact the value of your investments. Currency fluctuations can either enhance or detract from your investment returns, depending on the direction of exchange rate movements. Global economic trends. Stay informed about global economic trends, geopolitical events, and regulatory changes that may impact international markets. Factors such as trade tensions, currency devaluations, or political instability can affect the performance of international stocks. #19. Advanced investment strategies. Value investing. Value investing is a strategy pioneered by Benjamin Graham and popularized by Warren Buffett. It involves identifying undervalued stocks trading at a discount to their intrinsic value. Value investors look for companies with strong fundamentals, stable earnings, and a margin of safety. Growth investing. Growth investing focuses on identifying companies with above-average earnings growth potential. Growth investors typically seek out companies that are expanding rapidly, have innovative products or services, and demonstrate strong competitive advantages. Income investing. Income investors prioritize stocks that pay high dividends or regular income streams. These stocks are often found in stable, mature industries such as utilities, telecommunications, or consumer staples. Income investing can provide a steady stream of cash flow for investors seeking regular income in retirement or other purposes. Sector rotation. Sector rotation involves shifting investments among different sectors of the economy based on macroeconomic trends, business cycles, or market conditions. Investors may rotate into sectors that are expected to outperform in the current economic environment and rotate out of sectors that are expected to underperform. #20. Risk management techniques. Asset allocation. Asset allocation involves dividing your investment portfolio among different asset classes, such as stocks, bonds, and cash equivalents. By diversifying across asset classes with different risk and return characteristics, investors can reduce the overall risk of their portfolio and achieve more consistent returns over time. Portfolio rebalancing. Portfolio rebalancing involves periodically adjusting your asset allocation to maintain your desired risk and return profile. This may involve selling assets that have appreciated in value and reinvesting the proceeds into assets that have underperformed, bringing your portfolio back into alignment with your target asset allocation. Stop loss orders. A stop loss order is a risk management tool that automatically sells a stock if its price falls below a certain threshold. Stop loss orders can help limit losses and protect against large declines in the value of your investments. Dollar cost averaging. Dollar cost averaging is a strategy where investors invest a fixed amount of money at regular intervals, regardless of market conditions. By investing consistently over time, investors can reduce the impact of market volatility and potentially buy more shares when prices are low and fewer shares when prices are high. #22. The importance of investor behavior. Emotional intelligence. Emotions play a significant role in investment decisions. Understanding and managing emotions such as fear, greed, and overconfidence can help investors make more rational and disciplined choices. Emotional intelligence involves self-awareness, self-regulation, and empathy, which are essential traits for successful investing. Long-term perspective. Successful investors often have a long-term perspective and are willing to ride out short-term fluctuations in the market. Instead of reacting impulsively to daily price movements, focus on the underlying fundamentals of your investments and their potential for long-term growth. Avoiding herd mentality. Herd mentality, or the tendency to follow the crowd, can lead investors to make irrational decisions based on fear or greed. Avoiding herd mentality involves independent thinking, doing your own research, and sticking to your investment plan even when others are panicking or euphoric. #23. The role of technology in investing. Online brokerages. The rise of online brokerages has democratized access to the stock market, allowing individual investors to trade stocks, ETFs, and other securities with ease and convenience. Online brokers offer user-friendly platforms, low fees, and a wide range of investment options. Robo-advisors. Robo-advisors are automated investment platforms that use algorithms and technology to manage investment portfolios. Robo-advisors typically offer low-cost, diversified investment portfolios tailored to investors' risk tolerance, financial goals, and time horizon. Financial apps. There's a growing ecosystem of financial apps and tools that help investors manage their finances, track their investments, and make informed decisions. These apps offer features such as budgeting, goal setting, portfolio tracking, and investment research, making it easier than ever for investors to stay on top of their finances. Continuous learning and adaptation. Stay informed. The stock market is constantly evolving, driven by changes in technology, economics, geopolitics, and other factors. Stay informed about current events, market trends, and new investment opportunities by reading financial news, following market commentators, and staying engaged with the investment community. Continue learning. Investing is a lifelong journey, and there's always something new to learn. Whether it's exploring advanced investment strategies, studying market psychology, or deepening your understanding of specific industries or sectors, commit to continuous learning and self-improvement as an investor. Adapt to change. Be flexible and willing to adapt your investment strategy as market conditions change and new opportunities emerge. What worked in the past may not work in the future, so it's essential to remain open-minded and agile in response to changing circumstances. Investing in the stock market is both an art and a science, requiring a combination of knowledge, skill, discipline, and intuition. While there is no guaranteed formula for success, following fundamental principles, staying disciplined, and continuously learning and adapting can increase your chances of achieving your financial goals. Remember that investing is a journey, not a destination, and success often comes from patience, perseverance, and a long-term perspective. By building a solid foundation of investment knowledge, developing a clear investment plan, and staying focused on your goals, you can navigate the ups and downs of the stock market and build wealth over time. As you embark on your investment journey, embrace the opportunities and challenges that come your way and never stop striving for financial independence and security. Happy investing.